But we are going to talk about how to audit receivables substantively, okay? And we're going to talk about a little bit of controls, and we're going to talk about substantive, because every one of these accounts we're about to talk about, receivables, there's fraud. And if you don't understand where you can get caught in these areas, or receivables in account, listen, how do people commit fraud on financial statements? They, in a lot of cases, what do? They inflate or deflate assets, okay? So we need to have we have to know how to audit asset accounts, okay? And some of these accounts are very easily manipulated. So receivables are certainly one of them. I don't think I have to tell people at this level now what a receivable is, okay? You guys have been around long enough to know what an account receivable, but what kind of receivables do we have? We're going to have accounts receivable, we're going to have loans to officers and employees, which may sound like a very simple thing to audit, but in some cases, there's issues you can have when you have loans to officers as to whether or not they're collectible, whether they're actually, are they right? I'll tell you a quick story about officer loans while we get off on a tangent here. I had a client, two partners, two brothers. There was a loan on the books to one of the brothers. Let's call him the bad brother. I didn't like this guy. He actually accused me once of sticking a knife in his back, and I actually responded that if I was going to stick a knife in any client's back, it would be his. What this guy wanted to do, you tell me you do this. And if you say yes, I don't think you should be doing this. He owed the company money. He called me up one day in my office and said, Michael, I want you to write my loan off the books. I said, I can't write your loan off the books. I know it's half your company, but it's half your brother's. I can't write the loan off without your brother's approval. If your brother says write the loan off, I'll write it off, okay? Fine, you don't have to pay it back. Your brother agrees. I said, no, I'm telling you to write it off. I said, I can't do that. Half his company. I demand you write that loan off. That's where the conversation went south. And then the knife conversation, and yes, I was going to stick it in your back. He wasn't a nice man. Anyway, not all clients are nice. So anyway, you got a whole bunch of receivables here. Different types, claims for tax refunds. They've got to be audited in a way. But those are pretty simple to audit. So what's our concern here? Of course, are receivables correct? You're going to see this in every single asset account we go down with all the objectives. Substantiating occurrence, completeness. It's the same slide, in all honesty, substituting the word receivable for inventory. It's the same thing we're trying to determine and do all this different substantiation tests that need to be done on receivables. You're going to walk through internal control on receivables and revenues. Sometimes there's a lot to revenue recognition today, which of course affects receivables. Certain industries are much more susceptible to having problems in this. Some companies are very cut and dry. They make something, they sell it. The receivable is what it is. The revenue is what it is. There's a couple businesses that's not true of, and we will talk about a couple businesses that are much more difficult in this area, okay? When you do your internal control, this is where we're going to move along quickly. Division of duties, and there's all kinds of these. I'm not going to read them to you, okay? You're going to go through the revenue cycle, which again, receivables and revenue go together. All the things that go together in a control environment for receivables. I'd rather you just read these things. Again, we're talking about segregation of duty, keeping the salespeople away from the collection people, keeping the sales invoices away from the people doing the invoicing, away from the shipping. You can see where if you did both, you'd certainly have room for fraud in here. If somebody here could produce an invoice to their friend for $100, but ship them $200 worth of merchandise, certainly things like that happen. I've seen it happen where people are involved in both aspects of the selling and the shipping. But again, these are all normal controls. You keep the sales away from the credit people, things like that. Monthly statements to your clients so that they know what their receivable is. If somebody's taking money, that they're going to say I paid when the books show that they didn't. All these other revenue cycle controls, these are all part of your internal control. I'm not going to spend a lot of time on this. Audit documentation, this is where we start doing some other things. What are we going to get? We're going to get an aged trial balance. You need that. How do you audit receivables? Of course, by starting with an aged trial balance, listing all your clients and how old the receivables are. And you're going to get analyses of all the different receivable accounts. This is all, again, this is going to be very repetitive. Audit documentation is going to look very similar as we go through these different accounts, okay? This is, again, use the environmental, use the understanding of the client to come up with your procedures, get an understanding of the internal control. These are the same steps over and over again, okay? So let's move past the internal control part, okay? Let's start talking about substantive audit procedures, okay? We did our internal controls, but what are the substantive audit procedures that are, let's say, somewhat unique to accounts receivable? We, of course, start with an aged accounts receivable listing, okay? The client's going to give us, hopefully, a schedule that ties in to the general ledger of the accounts receivable at the end of the year. They're going to be aged, and they're going to be analyzed. In each one, it's going to have each client individually. Okay. Let's go down to number 4. We're going to talk about this in more depth. One of the most important procedures in auditing receivables. Again, we talk about outside verification, and we'll talk in a little bit more detail what that means in a couple seconds. But confirmation. What are we trying to do? We say the customer owes us X. We want the customer to come back to us directly as auditors and agree, yes, that's the amount of money I owe the company. This is our verification, not of completeness. It doesn't tell us we have all the accounts, because if they leave a receivable off and don't tell you about it, for whatever reason, it's hard to confirm something you don't know about. So this is attesting to the accuracy of the ones that you know. But this is a very, very important procedure that's required in most audits. And we're sending confirmations out to the debtors and confirming the amount of money that they owe. In a lot of companies, a sales cutoff is extremely important. We want to know that sales that were done in 2014 are recorded in 2014, that sales that are done in 2015 are recorded in 2015. So a sales cutoff, we're going to be looking at the end of the year and looking at the last transactions of this year and the first transactions of next year to verify that things are in the right period. That's a procedure you're going to do in most cases. You're going to do a lot of analytical procedures. Again, you're going to look at receivables and agings and see if they make sense. And eventually, again, we're going to test some valuations here, okay? I'm going to talk about the hardest parts of receivables in a couple seconds, okay? Talk about the propriety of the client's accounting methods, okay? In most businesses, the accounting methods and the revenue recognition are pretty simple. Like I said, you walk into Best Buy, they don't even have receivables. You walk out with your refrigerator and they have a sink, okay? Buying computers from IBM, they ship computers to Cohen. They have a sale. But there's some businesses, this isn't so easy. One of the most difficult businesses to determine how much money someone owes you. Did they teach you construction? Did you guys learn long-term contract accounting? You learned that, what, intermediate 2? There's a tough one if you're auditing, okay? How do you really know how to, you can play games in that one,
Isn't
okay?
that why that's the most, one of the most corrupt,
Yeah, and as an auditor in construction, you better know the construction industry. Those of you who came to see Tom on Monday, and I saw a bunch of you showed up, and I hope you got something out of that, okay? I've got another good one lined up already. In the fall, in September or October, I'm going to have, I got the managing partner of Ernst & Young to come speak to you about what's going on in the Big Four these days. The managing partner of the New Jersey office of EY is a friend of mine. I got him the other day, and he agreed to come down here and give another speech on what's going on in the accounting industry, more specific to the Big Four and how our students can fit there and what you would expect in a Big Four career. So it should be, we'll announce it when we have a date, but he promised me to come in September or October. So hopefully we'll get another good turnout. But Mr. Marino, he was an expert in the contracting business. Not because he understood how to make the debits and the credits. He knew the business. He could talk construction. So if a contractor was talking to him about stuff, he understood the industry. They couldn't BS him on what they were doing. Yeah, the calculations are according to, formulas. But you got to know the business to know what makes sense in there. So, and he was very good at that. So there's one that's tough. And then anything that has what's called multi-deliverables. Did they explain to you what multi-deliverables is at any point in your career? Multi-deliverables is when you buy something, but there's different parts to what you're buying. For example, you're buying a computer system. You're buying hardware, software, training, and maintenance, okay? All part of one contract. How do you record income on that contract? Because there's multi-deliverables. They got to bring you the hardware, they got to install the software, they have to train your people, and they got to keep it maintained for a couple of years. And it's all part of one price. How do you recognize revenue and receivables in that case, okay? So there's certain times that receivables and revenue can be rather difficult. In fact, there's some new accounting guidelines out there on revenue recognition. It's probably been one of the areas that's been hottest in the last couple of years. Let's look at number 11, because this is one. They put it up there as one line. But if you don't think this isn't one of the toughest things to audit on a client's books, adequacy of the allowance for doubtful accounts, for bad debts. Anytime, and there I even had a question on the last exam, the hardest things to audit are estimates, okay? They're hard to audit, okay? They're unauditable, they're unverifiable. They're all a smell test, okay? So, when they put up on the screen, determine the adequacy of the client's allowance for uncollectible accounts, you think you put your youngest staff accountant on that calculation? Of course not. You put an experienced senior or manager who understands all the aspects. What do you have to know? You got to look at an aging. You got to look at the industry. You got to look at the economy. And then you got to be able to go down the client list and see the receivables and look for problems. Look for things that make no sense, okay? You look and you see a client and you see their receivables and you see, you see $1,000 in the 30-day column and nothing in the 60-day column and nothing in the 90-day column. And all of a sudden out here in the 120-day column, all of a sudden you got $20,000 out here, okay? Example. And you say, they sell to this client every month. This client buys from them every month. Well, you can see they paid the 90-day money and they paid the 60-day money. Why didn't they pay the 120-day money? That's the oldest invoice. They didn't pay that one. So now you got to go sit down with the collection people. And do collection people always tell the truth? You think they overestimate what they're going to collect? Of course, that's their job. You think the collection person wants to say, oh no, I screwed that one up royally. I forgot to collect that one. Tell the boss I blew it. No, that's a good one. So you as an auditor have to have the common sense to be able to look at stuff like this and make common sense. And when the client says my receivables went up, but my bad debt reserve has gone down this year, I need my bad debt reserve, I think it should be lower. You go, well, your receivables went up, the economy sucks, your industry's in trouble, and your sales went down, okay? Doesn't make sense that my bad debt reserve should be going down. My logic says it should be going up, okay? And you tell the client, by the way, your reader's going to read the financial statement, they're not going to understand that either. They'll look stupid there. Why did your bad debt reserve go down when your receivables went up, okay? In a bad economy. So auditing this is not easy. It's a matter of, again, sense of, you as an auditor, you've got to get a sense of what's right, what makes sense to you, okay? You always got to know whether receivables have been pledged. That's why confirmations are important. You got to disclose it. You got to tell the reader, hey, those receivables belong to somebody else in case there's a problem, okay? Does the client always tell you that? Not necessarily. Can you sell receivables? All right, you can. Which industry does a lot of that? Who? Textiles. Garment. Oh, does anyone know what the term is when you sell receivables? Factoring. Exactly right. Factoring. You sell receivables, normally you guarantee them, you might have to buy them back. So you don't want to, you want to make sure that they don't have receivables on your books that actually belong to somebody else, okay? Related parties, always got to look at this. Always got to look and see whether the receivables are from related parties. Because again, you've got disclosures in that regard. And of course, always looking at unusual and significant transactions. Always important. Auditing, again, always comes down to this. You'll be a good auditor. You'll be a good auditor. You'll be a good accountant if you actually do what the heading says on here. Understanding a client's business. Not only does it make you a good auditor, but to be honest with you, it'll make the job more interesting. If you ask me, give me 5 reasons why I did what I did for so long, besides I made a lot of money. I mean, I paid fairly well, and I don't know anything else, so if I could be an accountant, I don't know what, I guess flipping burgers or something, I have no idea. But I always found that interesting. And what I liked about public accounting, and again, I've run you through some of the things I did, I like the fact that, I got a kick out of understanding exactly how a casino works after my 10 years in Las Vegas, okay? Understanding the concepts of why a casino makes money and all the things that go into it. And when I audited at supermarkets, understanding all the psychology and how a supermarket is laid out in order to induce you to spend money, okay? And believe it or not, when I spent 6 weeks every winter for many years up in Maine, auditing chicken farms, and I think I told you, I mean, watching how the poultry industry actually works, okay? But the whole concept was how do you feed chickens and get them to market quickly and how you make money in those? I don't know. If you said to me, Dad, why'd you do what you did? I would say those were the reasons I did it. So I always loved getting that. That's why I like to walk through it and new potential client. I walk through and I always have too many questions. I think I told you the story. I really blew a sales call last year, one of my last years, because when we went out to a potential client, I said, oh, will you show me the warehouse? The guy, I'm mad. He goes, why you got to see that? It just seemed like a logical thing in terms of trying to be your accountant. See what you do. That meeting ended poorly. I got yelled at by my partners. They said, why do you annoy him so much? I said, I'm just asking questions. Is that what you do? Is that our job? Anyway, so all this stuff of understanding your client's business, how they price, this all is going to make you a better auditor because if you understand how they run their business, you'll know when you look at the numbers whether they make sense in accordance with what the business is. Where do you expect, where do you expect to see receivable problems, okay? Understanding revenue recognition. All this comes from not just reading textbooks, but actually asking the client what's going on and understanding their business. So we always ask our auditors, that's what you do, learn the business. Fraud risks. Well, again, have I seen fraud with receivables? Yeah, I have. I've seen receivables that weren't real. And I saw receivables written off that shouldn't have been written off. It doesn't happen often. But again, where do people play games with? Asset accounts, steal cash, monkey around with receivables. And the worst is going to be the next chapter when we get to inventory. Because it's absolutely the most difficult to audit. For the most part, receivables aren't tough from a valuation standpoint. A client owes, where's the valuation on receivable? It's on the bad debt reserve. You determine somebody owes you money. They owe you what they owe you. Inventory is a little bit different. So the bad debt reserve is your biggest risk in terms of, if you've got all your receivables, And bad debts, unless, again, it's an estimate. Nobody can really come after you unless you're dramatically off. It's a judgment to some degree. Let's talk about the confirmation process. Probably the number one substantive audit procedure that we perform on receivables. What do? Well, again, it's almost mandatory that you do confirm receivables unless they're immaterial. You're not going to confirm receivables if you're auditing a Burger King, okay? Unless you've got accounts there. I don't think Burger King sells uncredited, so you don't worry about receivables if they're immaterial. I mean, Walmart, for example. Walmart doesn't have big receivables. You go into Walmart, you pay with a credit card or a debit card or cash. So as big a company as Walmart is, accounts receivable is an immaterial amount there. You're not going to worry about it too much. Or confirmations are going to be ineffective. If all their vendors are the type that cannot confirm your receivables, sending them out, becomes a waste of time. You're not going to spend a lot of time on some procedure that doesn't work, but you're not going to get a response, or you're going to get such a poor response. So you got to know that, and you got to know historically, if you've been auditing a company, what kind of confirmation response you get. So again, we're always trying to be efficient. Why spend a lot of time sending first and second confirmations and using that as an audit procedure if it doesn't work? So again, unless your risk is so low here, you can get rid of or not do. If you assess your inherent risk on the receivables as being extremely low, you can make a determination and write up why you're not confirming receivables. But for the most part, it's a procedure you should expect to do, and you're going to go out as auditors, and I can guarantee you this is going to be one of the first things you're going to be assigned as new staff accountants, confirming accounts receivable, okay? So what's the process, okay? Remember, again, we got to keep it independent of the client. So we start with, again, we start with picking whatever our sample is based upon chapter. What chapter did I teach you sampling? 9. Remember when we did 9? Yes. We forgot to tape it that day, right? Okay, thank you. That chapter. Okay. So what happens? Clients can prepare confirmations for us. What we would do is make a sample selection based upon Chapter 9. We would have we would give the clients forms. We're going to talk about what different kinds of forms we can use. Clients would prepare. Do we let the clients mail them?
No.
Absolutely not. We have to mail them. They have to be handed to us so that we can make sure they're all going out. We mail confirmations out to the clients. Do they come back to us or to the client? Absolutely. Directly to us in our offices. You put a return envelope in normally so that you get a response. So they can just go yes and put it in the envelope and mail it back. And if you don't get first back, okay, normally what you have to do is send a second request, okay? So what's the okay. There's 2 types of confirmations, okay? We have what's called positive and we have what are called negative. And the positives have 2 different methodologies to them too. You can send them with a balance on them to a client and say, okay, according to the records of the XYZ company, you owe them $2,000 as of December 31st. That's correct, sign below. It's a positive confirmation, meaning we need to get a response. Okay? Or you can leave them blank and let the client fill it. You want a response? You want a better response rate? You put the number in, okay? Why? Because the client, the receivable, the company who gets it says, I got to fill this out, has much less incentive to fill it out than to just signing one that's already filled out for it. So normally, again, what are you trying to do? Match your records to theirs. So might as well tell them this is how much it is, okay? And just let them hopefully agree. But a positive confirmation, you're expecting a reply. Does anybody know what a negative confirmation is?
Do not reply if this is correct.
Do not reply if this is correct. And the assumption is that if they don't, they'll respond if it's wrong, okay? Well, I don't know if they respond if you tell them too little. They think they owe you $100 and you tell them it's $50, they don't respond, okay? But you normally don't use this unless you have a very low level of assessed risk, okay? Or a lot of small balances. Remember, you're trying to feel good about your numbers, okay? You have a lot of assurance that the numbers are good. So if you've got big receivables, if you've got a type of a client with maybe a small number of accounts but all big accounts, you're going to want responses. Because one that's wrong could be material. You're much more likely to use this when you have a lot of accounts but they're all small. So that if you've got a client that just doesn't respond even if it's wrong, unless you have a lot of them, you don't have the material to say. Okay? You're going to use a positive for the most part. Anytime you have clients with reasonable number of receivables, large dollar amounts, you're going to want to see that come back because it gives you that, again, that's a very good audit documentation that you've got a positive response on a receivable balance. So quickly, the flowchart of the confirmation request, you get your audit objectives, you pick the right form, the timing and extent. What does it mean by that? This is one of those procedures that you can do during the year, okay? If you want to, again, save yourself year-end time, you don't have time in February, you can do the audit confirmation process and confirm the September balances, the October balances, and then just roll forward with other procedures. You pick with the information you want to confirm, you prepare and mail them, you send seconds if you don't get them back. But if you use this as a procedure, especially on the positive confirmations, and you don't get a response, you can't leave your work papers open and say, we sent 20, we got 10, the 10 we got are okay, we're done. You're asking for it right there. Alternative procedures for non-respondents. You got to do something else if they don't answer. So you got a big receivable that refuses to answer you, you got to go vouch invoices, subsequent payments, you got to do other procedures because you picked a sample. If you're using sampling, you got to audit the sample. So if the procedure you're using for the sample is confirmations, if you don't get them, you're not done yet. You got to do secondary procedures, and you have to resolve exceptions. You can't just say you got 5 in and there's 5 wrong, and you say, well, okay, 5 out of 20, that's not bad. You got to resolve everything, and you got to figure out why they're wrong. Because if you're getting exceptions, what does that tell you as an auditor? You got to do more work. You got to do more work. You got to look at more accounts. You've gotten problems, okay? And always document what you did and what the results were. You don't just leave it open-ended. It sounds crazy. Of course you do that, right? If there's anything that accountants get written up for by the PCAOB, peer review, internal peer review, all the time, you're going to hear this all the time. Documentation, documentation, documentation. You did the work, you didn't write down what you did enough. You didn't explain what your results were and why you concluded, okay? You did it, and then you left it open-ended. Yes?
Is there a lot of writing in it?
A lot of writing? Yes. Yes, there is a lot, isn't there? Every work paper. You got to explain what your conclusions are. Now, sometimes your conclusion is immaterial, it's okay. But yeah, I concluded it's okay and why, you know.
Stuff like this, big paragraphs.
Yes. You can't tell. Yes. A lot of writing.
Big paragraph. And you have to mark it in red and make sure it's right.
And we're not going to go down the road of revenue recognition. This is really not an audit. This is not, there's a lot of stuff to revenue recognition that's more an accounting than an auditing concept. Let's put it this way. When you're auditing a company, you need to know the revenue recognition rules, particularly as they apply to the industry that you're dealing with. Understand, again, the client's business, and you'll understand when revenue should be recorded and when not. There's some general rules, again, about collectability and things like that. fixed and determinable price. In other words, you can't sell something, price is going to be determined later. Delivery of services, this is all sort of common sense. Some industries, again, have all little nuances to that. Where do you find revenue recognition problems, unusual rates of return? There's side agreements, franchise fees are a little unusual. Does everybody know what bill and hold Does anybody know what a bill and hold is? And as you learn, percentage of completion method, very tricky. Okay? We talked about the allowance for bad debts. How do you analyze that? How do you really know if it's any good? Well, one of the tests you're always going to do in accounts receivable, subsequent cash receipts. What's the best evidence that a receivable is good? Somebody paid it, okay? It doesn't verify when it was a receivable. I get paid on January 10th for a receivable. I can make the sale on January 3rd. So you might have the receivable in the wrong period. But subsequent payments are one of the best documentations that a receivable is any good. If you get it. What's the easiest way to make sure your reserve for bad debts is perfect? Come in and audit late. If you can hold off an audit, a December 31st audit, and the client says, come in the summertime, I don't need the financials. Well, you come in 5 or 6 months later, you have a pretty good idea which receivables are good or not. Because 5 or 6 months later, they're paid or they're not any good. But you come in on January 10th for December 31st company, receivables aren't quite yet. The later you can go, the better you can do in terms of a subsequent payment test, okay? Helps you with your allowance for bad debts. This is a whole bunch of procedures you can use in there. Again, how are you going to audit it? You're going to talk to credit managers. You're going to ask a lot of intelligent questions. You're going to look at the aging. You're going to look at the industry. All those things are going to help you with at least coming up with an allowance for bad debts that makes some kind of a sense. Related parties, how do you find them? Well, you got to, again, if it's a public company, they've got to tell the SEC about related party transactions. And you're going to look for things with unusual terms, which sometimes tell you this wasn't an arm's length transaction. Voila, receivables. We're going to spend a little time on inventory, okay? Okay, let's talk about auditing of inventory. What is special significance of auditing inventory? Valuation. Valuation of inventory. First of all, we have lots of methods of inventory valuation. Okay? You have inventory sometimes in process. That's hard to audit. Well, okay, if you're going to be a disturbance because of her, then I throw you out.
Me, you throw me out.
I'm throwing her out.
No, you.
Can we not talk to her though? Thank you. That's fair. Thank you.
Not fair.
Okay. Valuation on inventory. Extremely difficult. There's a whole bunch of places we can trip up along the way. Obviously, we need a methodology, which we need to know how to do, FIFO, LIFO, average cost or whatever. Work in process, finished goods, calculations, extremely complex sometimes. Got to make sure quantities are right. Is quantity of inventory simple? Sometimes yes, sometimes no. Yeah, walking around a grocery store counting cans of peas, not so hard. Walking through one of our largest public companies, I think I told you, is a scrap metal dealer. Try counting that inventory. You think it was easy for me? I think I told you the story when I did the chicken inventories. And I walked onto a chicken farm and they told me there were 50,000 chickens. God's honest truth.
You counted every chicken.
Well, the old joke was, how you do it? You know, you count the legs and divide by 2. That was one of the most. There was parts of that inventory I told you. The story about climbing up on the silo. Did I tell you that?
No.
Okay. You like this story?
How was the dress code?
You like this story?
Dress code or like.
So they send me on the chicken inventories. On the Lewiston and Portland, Maine. Middle of winter, okay? So fraud in inventory is so easy. Excuse me?
But they put
Yeah, but
all
they had
water.
to silent. They just filled it with water. But in this case, probably. So there's a lot again. Inventory. There's so many aspects to inventory. You see this screen? The objectives. It was the same objectives pretty much that we had on receivables. We're just substituting the word inventory. Okay. So we're substantiating the existence, the completeness, and all of these are relatively hard to do in some cases, especially depending on what kind of a client you have. What happens when you have a client that's buying merchandise from all over the world, being shipped on boats and all that, it's being shipped FOB shipping point. You got boats out in the middle of the Pacific if they're buying merchandise from over there. You got inventory located all over the world in different places, warehouses, outside warehouses. Sometimes it can be extremely complex. This was some type of a fraud case with inventory. Okay. Inventory methods, you learn this in financial difference between periodic and perpetual. Physical observation of inventory is required. Any client we have, if inventory is a material number, okay, you're going to observe. Now, are you going to observe all of them? No. You talk about clients who have multiple locations, okay? Let's take our Burger Kings, okay? Say we have a client that has 30 Burger Kings. Am I going to go out and count inventory of December 31st and 30 Burger Kings? No. What is the chances that inventory of Burger King is going to be relatively consistent store to store? When you say pretty close, what are they going to have? They're going to have X number of burgers and X number amount of cheese and lettuce and French fries within some relative. One store is not going to have 20,000, the next store has 150,000. It's not going to be like that. You know that it's going to be relatively small because turnover. They're getting merchandise every day, okay?
Well, there's also food guidelines.
Take a supermarket. Say you had 20 supermarkets in your chain. You know what you use as a, say you count 5 of them, okay? What kind of analytical procedure could you do to make sure that they're all okay? Or what do you think you might use? Who said? What'd you say? Yes, sir. No.
What you say? Wouldn't you base it off of your sales so that you know that's how much?
Sales is one. Well, you know what else you could use? A room.
So.
I'm asking you a question. You're auditing a supermarket, okay? You got 20 supermarkets in the chain.
That's it.
That's it. We don't want to count all 20, okay? So you count 5. I didn't think you could analytically know after you did 5 whether the other 15 seem reasonable. How about square footage? How about square footage in a supermarket? For reasonableness, doesn't an inventory in a supermarket vary? The bigger the store, the more inventory? So if I had a 10,000 square foot inventory store, and normally if I have a chain of supermarkets and I have consistent supermarkets, I'm a ShopRite, I'm a Food Town, I'm a King's, I'm one of those, right? So if I counted 5 of them, right, and I was happy with 5 inventories, and I looked at the square footage, and I said, okay, here's how many dollars per square foot I have, I could look at the other 15 for reasonableness and say, analytically, they make sense. So again, it's a lot of common sense then in terms of this. But there is a requirement of counting inventory, depending on, again, materiality. But we do it on every client. It's an audit procedure you need to do. Now, do you have to count it at year end? No, you're right. You don't have to count it at year end. But if you don't count it at year end, you have to do anything different.
Yes.
What do you do? What's it called? What'd you say? Roll forward, yes. Roll forward. In other words, say you counted it November 30th because it's easiest, okay? Because you don't have enough staff to do it on December 31st. You count it on November 30th, and then you audit the purchases and sales for the month to see if December's numbers seem reasonable. So you can do it off-site. counting inventory is key. That's why I had to count the chickens. Did I count them? Obviously not. Did I observe and see that they were reasonable? Of course.